Warning: IRS is flagging these 5 payroll mistakes in 2025. Audits are up 300% 3 weeks ago. My client opened a letter from the IRS, 13,200 in penalties, because her payroll software miscategorized one employee. One checkbox destroyed her entire year. Here is what makes this worse. She did everything right. She used popular payroll software. She paid on time. She filed quarterly. And she still got flagged by an algorithm that is now catching mistakes it used to miss entirely. The IRS allocated $80 billion in new funding over the next decade. They hired 87,000 new agents. And in 2025, small business payroll audits have increased by 300%. Not 30%, 300. But here is the part they do not tell you. The IRS is not manually reviewing your returns. They are using AI pattern matching that cross-references your payroll data against 47 different databases simultaneously. And there are exactly 5 mistakes that trigger this system almost every single time. The 5th mistake on this list is the one that gets overlooked the most. And it is the reason 23% of all small business audits start in the first place. We will get there. But first, you need to understand why everything you thought you knew about payroll compliance changed in January of this year. I have spent the last 8 years helping small businesses navigate tax compliance. I have seen audits that bankrupted profitable companies. I have seen penalties waived completely because the business owner knew exactly what to say. The difference is never luck. It is always information. By the end of this video, you will know the 5 specific payroll errors the IRS AI is programmed to detect, the exact dollar thresholds that trigger automatic review, and the one protection strategy that reduces your audit risk by 74%. That last number comes directly from a 2024 Treasury Department study, and almost nobody is talking about it. The first mistake is the one that destroyed my client's year: misclassifying employees as independent contractors. Sarah ran a marketing agency in Austin. 12 people worked for her, 9 employees, 3 contractors. At least, that is how she classified them. Her payroll software asked a simple question during setup: does this person set their own hours? She clicked yes for her 3 graphic designers because they worked remotely and had flexible schedules. That single click cost her $14,200. The IRS does not care if someone works remotely. They do not care about flexible hours. They care about behavioral control, financial control, and relationship type. If you provide the tools someone uses to do their work, they are probably an employee. If you control when deliverables are due, even if you do not control when they work, they are probably an employee. If the relationship has no defined end date, they are almost certainly an employee. Sarah's designers used software she paid for. They attended her weekly team meetings. They had been working with her for over 2 years with no contract end date. In the eyes of the IRS, they were employees. And Sarah owed back taxes, penalties, and interest on every single paycheck she had ever issued them. The IRS AI catches this by comparing the 1099s you file against average contractor payments in your industry. If you are paying someone $65,000 a year on a 1099, when the industry average contractor payment is $8,400, that is a red flag. The algorithm does not know your business. It knows patterns, and your pattern looked wrong. But here is what nobody tells you about this mistake. There is actually a way to correct a misclassification before the IRS finds it. It is called the Voluntary Classification Settlement Program. You pay 10% of the employment tax that would have been due for the previous year, just 1 year. And you agree to treat the workers as employees going forward. No penalties, no interest, no questions about previous years. Sarah did not know this program existed. By the time she got that letter, it was too late. The second mistake is failing to deposit payroll taxes on time, and the penalty structure here is designed to escalate fast enough to destroy a small business. If you are 1 to 5 days late, you pay a 2% penalty. 6 to 15 days late, 5%. 16 days or more, 10%. And if you are more than 10 days past your first IRS notice, 15%. Marcus owned a plumbing company in Ohio. 18 employees. His payroll was due every Friday, which meant his federal tax deposits were due the following Wednesday. 1 month, his bookkeeper was on vacation. Marcus made payroll from his personal account to make sure his guys got paid. Good intention. But he forgot that personal account was not linked to his payroll tax deposit system. The deposit was 17 days late. That is past the 10% threshold. On a $23,000 tax deposit, he owed $2,300 in penalties. But here is where it gets worse. The IRS AI flagged the late deposit and automatically reviewed his previous 4 quarters. It found 2 other deposits that were 3 days late, deposits he had already paid small penalties on. The system calculated a pattern. Marcus was now categorized as a compliance risk. His next audit probability jumped from 0.4% to 11.2%. 1 vacation, 1 forgotten login, 1 late deposit. And now he is 28 times more likely to be audited than the average small business. The solution is painfully simple, but almost nobody does it. Set up backup deposit authorization. Most payroll systems allow you to designate a secondary authorized signer. That person gets notified if a deposit is not initiated 48 hours before the deadline. Marcus had this feature available in his software for 3 years. He never turned it on. The third mistake is the one that makes accountants lose sleep. Incorrect wage reporting across forms. You file W-2s for employees. You file 941s quarterly. You file 940 annually. You might file state unemployment returns, local tax returns, workers' comp reports. Every single one of these forms contains wage data. And in 2025, the IRS AI cross-references every single number. Jennifer ran a bakery in Portland. She had a payroll discrepancy of $2,847 between her Q3 941 and her annual W-2 totals. The error was a timing issue. An employee started mid-pay period, and the software rounded the quarterly figure differently than the annual figure. $2,847. That is a rounding error on a business doing $1.2 million in revenue. But the AI does not understand context. It sees a discrepancy. It flags the return. Jennifer received a CP 2100 notice requesting documentation for her entire payroll, all 12 employees, all 4 quarters, plus all supporting documents including time records, pay stubs, and bank statements. She spent 43 hours compiling documents. She paid her accountant $3,200 to respond. And at the end of the process, the IRS agreed she owed nothing, $0. But those 43 hours and $3,200 were gone forever. Here is the real problem. Most payroll software does not automatically reconcile across forms. It calculates each form independently using slightly different rounding rules. If you are running payroll manually or using basic software, you need to reconcile every quarter before you file. Compare your 941 totals to your running W-2 totals. They should match to the penny. If you are using newer AI-powered payroll tools, many of them now do this automatically. They flag discrepancies before you file instead of after. Some of the newer voice AI tools, like the ones you can build through platforms like 11 Labs at try11labs.io 2PU1092JL1, are actually being integrated into customer service systems that help businesses answer employee payroll questions accurately, reducing the documentation errors that lead to these discrepancies in the first place. If videos like this help you protect your business, hit subscribe. I drop one of these every single week. The fourth mistake is ignoring state-specific rules when you have remote workers. This used to be a minor compliance issue. In 2025, it is an audit magnet. The IRS has information sharing agreements with 47 state tax agencies. When you file a W-2, you report where the employee works. If that state does not see a corresponding state withholding return from your business, they notify the IRS. The IRS adds that flag to your file. David ran a SaaS startup in Delaware. 3 employees in Delaware, 2 in California, 1 in New York. He filed everything correctly for Delaware, but he did not register for withholding accounts in California or New York. California sent him a notice for $8,400 in back withholding, plus a $2,100 penalty. New York sent a similar notice, and the IRS flagged his business for misrepresenting employee locations. The fix requires 3 immediate actions if you have remote workers. First, determine every state where an employee physically works, not where they live, where they actually perform work. Second, register for withholding accounts in every single one of those states before you process your first payroll for that employee. Third, configure your payroll system to withhold correctly for each state. Every state has different rates, different local taxes, different rules. The fifth mistake is the one that causes 23% of all small business payroll audits: inconsistent payment records. The IRS AI compares 3 data sources: the payroll you report on tax forms, the payments you make from your bank account, and the deposits you claim on your business returns. If these 3 numbers do not tell the same story, you get flagged. Rachel owned a consulting firm. She paid her employees $18,500 every 2 weeks through her payroll system. But occasionally she would pay a bonus outside the system, just a direct Venmo transfer to reward someone for a big win. Over the course of 2024, she sent $12,000 in bonuses through Venmo. She reported those bonuses on W-2s. She paid the taxes,